Hey everyone, Unblocked is a bi-monthly event series where guests are asked questions in an AMA-style format, focusing on questions relevant to early-stage startups and blockchain technology. Unblocked is sponsored by DLab, a startup accelerator and venture studio that sits within the SOSV family. You can find out more at www.dlab.vc. We hope you enjoy the conversation.
Well, welcome everybody. It's my great pleasure to introduce my guest today, Dan Hannum, who's the CEO of Zen Ledger, which is a platform for simplifying DeFi and cryptocurrency taxes for investors and tax professionals. Daniel, welcome.
Thanks for having me, Paul.
Yeah. So before we delve into like all the specific tax questions I have, and there are numerous, and I'm sure everyone listening has numerous as well, I'd like to talk a little bit about like Zen Ledger, like how old is it? And what I'm interested on is what made you be like, shit, this is like a massive problem. I'm going to drop what I'm doing and I'm going to work at Zen Ledger and try and solve this.
Sure. Yeah. So happy to provide a little bit of context. My involvement with Zen Ledger was actually from an investment perspective before an operational perspective. So my background very quickly was largely in traditional finance. I spent some time up in Wall Street at Morgan Stanley and then TD Ameritrade. Then made the jump into crypto full time at a company called Blockchain Capital, one of the leading funds here in the crypto space. Spent some time there for about a year and a half, and then ended up leaving in early 2016 and raised a $25 million fund that was a venture-specific fund for crypto and blockchain-based companies. So that's kind of like a quick background. And through that fund, back in 2016, 2017, we started looking for more of like the picks and shovels and the operational side of the industry. So how do we get people onboarded into crypto? Once they're in crypto, what are the tools, resources, applications that they're going to need to be able to interact? And then how do they comply easily and accurately? Fast forward about a year and a half, we hit the ICO kind of craze in late 2017. We started seeing prices increase from, I think Bitcoin went from like $1,800 to like $19,000 in like a 3-week span. And most of the other assets rose with that. So we saw like huge amount of capital come into the space. Obviously, when that amount of capital comes in, we saw a lot of people making a lot of trades and transactions. And as someone who has been personally investing in the industry before I invested from a venture perspective, I was always trying to understand how to get my own taxes done for the right way. I know it sometimes goes against the crypto ethos to want to be filing your taxes, but I've had other companies, other businesses, other income, and for me, it was not worth trying to take the risk of not filing. So I was like, I'm just going to, get ahead of this, make sure that I'm compliant. And, I'd rather pay 10, 20% of my income and just know that I'm, good to go. Long story short, in 2016, 2017, was using like Google Excel spreadsheets, Google Docs, handwritten notes. It was just like a complete mess. So I met with Pat and Brian, CEO and CTO respectively, who came to us with an idea of, automating and providing like the TurboTax for crypto. And that was just such a no-brainer, not only from a business perspective, but just like I needed it. All of my friends were asking about it. It was just like a very clear use case. So I guess, long story short, the way we got involved was actually from an investment perspective of providing funds in the seed round. Pre-seed round. So they did a convertible note and then a seed round. And then actually on the seed round is when I joined full-time as a COO. So I have an interesting perspective as being an investor now an operator of the business. But that's actually how I originally got involved. And it was, from a perspective that I saw this industry could grow to be very large one day. And, I think we've seen some traction since 2017 up until this point. And then, just saw that it was a product that myself and my friends and people in the crypto industry would need. So it was kind of a no-brainer from that perspective. And when we were looking at, the checklist that we have on when we're investing in projects, team, total addressable market, all those kind of categories, it was like, oh, this is a no-brainer. And then I was kind of looking for the right opportunity to really spend more time on. Being an investor and being a VC is super fun. You get a lot of access to early stage projects, but for me, at least, I didn't feel like I was really building something. I felt like I was helping other people build their dreams and their vision. There's a lot of fun and reward from that, but there was a missing piece that I felt like I needed to kind of go build something, and I was looking for that opportunity. And it all kind of came together where I could join as a COO and kind of help lead and grow and scale the company from where we were to where we are now, and hopefully into the next chapter of our progression as well.
Yeah, no, that makes sense. It's kind of like as an investor or like a VC where you're investing in a lot of projects, your work is like a mile wide, but an inch deep. So I guess you wanted the opposite. You wanted a mile deep and an inch wide. And so like when you look at Zen Ledger, I guess today, and I'm sure there's been other competitors because it does seem like a no brainer, like, automated taxes for crypto, particularly because, all the data is out there to begin with. It should be a relatively, on the surface, right? When you first think about it, you think it's a relatively easy business to automate. Is that the case, or is it still super complicated to automate?
Yeah, happy to answer kind of both of those questions. I guess I'd start off with like the automation side first. One thing that's not very apparent until you are operating in the crypto ecosystem is the lack of reporting that goes between exchanges and between providers. And what I mean by that is if you're investing with E-Trade, TD Ameritrade, Schwab, Fidelity, whoever, the ability for them to understand your cost basis and then have an easy and accurate way to report that cost basis to the next provider is very easy. It's been there, it's been done. So that's how you can open up an E-Trade account, trade some transactions, and then go into Schwab, and like your taxes aren't all messed up. So
yeah, is that related to like ACAT, or is that something different?
Kind of. There's obviously like KYC and AML, which is like more of like, monitoring funds and transfers of funds and making sure, that the people that are moving those funds are, upstanding citizens and things like that. But then there's also just like back office, like reporting of, tracking the cost basis between what happens and then making sure that it's processed to the next provider. But in crypto, we really don't have that. And it's not necessarily like the exchanges haven't done that. It's like the ability to do that is very complex. So if I buy one Bitcoin on Coinbase, as soon as I send that Bitcoin off of Coinbase, I've already obscured the cost basis. Even if I send it to a Ledger wallet or to Binance or to KuCoin or to Gemini, anywhere I send it, the exchange can only see what happened in the exchange, not what happened since. And the thing with crypto is that most of these investors are using multiple exchanges, multiple wallets, multiple protocols, and they're moving funds between, from Binance to KuCoin into a decentralized exchange, decentralized into Uniswap into now NFTs. Like there's just a lot of activity happening in crypto, and the average user is using anywhere between 4 to 6 exchanges, between 8 to 10 wallets. And now with the prices increasing about 50 to 100,000 in total asset volume. So I guess long story short, the opportunity for us to automate that is because we can aggregate all of that activity across all of your exchanges, across all of your wallets into a very easy to use, very simple platform that can give you a comprehensive overview of your complete crypto tax perspective. So if you get like a 1099K or 1099B from Coinbase, most of the time that's not very helpful because you moved your assets into a ledger, into a nano, into whatever. So that, I guess that's more of like the automation side. As far as the competition side, you have it right. Like the U.S. tax code in itself is not a defensible moat. Like it's not hidden IP. You can't you can't patent it. It's like that's the code. So the competitive advantage is, what we looked at when we went through the venture perspective. It's a team. So our CTO, Brian Starbuck, led, multiple dev units at Microsoft. He's been in his own startups for about 15 years with 4 exits. His last exit was a $3.5 billion exit with Assurance. So when you talk about people who have been there, done that, and know how to raise capital, deploy capital, and then have a successful exit, you want someone like that on your team. Pat, our CEO, Chicago Booth MBA, United States Air Force Academy, Navy helicopter pilot, then was leading multiple business units at Amazon. So I guess from like the core team perspective, it's like great team, great product. Obviously, giant total addressable market. We set about an $80 billion market in tax in the United States alone. So those are some of the reasons why like it was a kind of a no-brainer. From the competition, I think it's the team, the integrations, the ease of use, and then the pricing as well. So as a venture-backed business, we can afford to have a little bit lower pricing because we can subsidize that pricing with growth. And then we can also use that capital to hire great engineers, great developers, and build out additional functionality that our competitors don't have. And as crypto continues to take like these next chapters into the arena and into the industry, that kind of provides a deeper and deeper and deeper moat. So when like Bitcoin Cash, one of like the largest forks came about, we were the first to code up Bitcoin Cash. We could then code it up, market it, and support it. Same thing with like EOS, which was like the largest ICO. Built it first, coded up, had it ready to go. DeFi. So we had DeFi integrations about a year ago before like DeFi became super popular. So once again, it was just like using the team, using the core functionality we had. And then every time we build that next thing, that's one less thing that our competitors have to kind of keep up with. So I'm not naive enough to think that it's like a winner take all arena. Like they call it the big four accounting firms for a reason. It's not the big one accounting firm. So, I think there's going to be 3 or 4 different providers. And, I hope and believe that we'll be one of those moving forward that can take this industry from, a $1.5 trillion asset class to $100 trillion asset class over the next couple of years.
No, that makes sense. And I guess I call it, I think it used to be the big 6, and then I think one of them fell out because of Enron, and then anyway, so it's, maybe in a couple of years it'll be the big 2. But I certainly agree that with your view that team is like massively important, because a high quality team will just be able to execute and figure shit out and get shit done. I guess so Zen Ledger's main customers, am I correct in understanding that your main customers are really just investors, individuals, not so businesses? Is that correct?
Yeah. So that was more of a calculated decision on the addressable market at the time and what we thought would be the addressable market moving forward. Excuse me. So really back in like 2017, 2018, there really just weren't that many funds or businesses that were using, accepting crypto, things like that. So at the time, we knew that there's probably globally about 40 to 50 million users and about probably 5 to 10 million users in the US that had taxable income, taxable events, capital gains from using crypto. So the market was just so much larger to go on the retail side than it was to try to be like a back office or like a fund admin for these funds, because there was 10 funds and there was like 5 companies that accepted crypto. So just like the market wasn't there. We've gotten into that market now, but I think that's because of all the automation, AI, ML, and process that we put into place on the retail side. So we have like an obscene amount of transaction activity that's gone through our software that we can really refine, use to get better and things like that. And that refinement, those AI, that ML allows us to really go to these funds, go to these businesses and say, hey, we can solve some of these issues for you. So yes, you are correct. And right now we're primarily focused on US-based investors and on individual investors. So we have 4 different pricing tiers ranging from 0 to $399 per year. And that, so we can really solve an issue if you're, let's say, a new user into crypto, you use Coinbase, you made like 5 trades per year, 10, 15 trades per year. We'll give you your tax reports for free. If you're like a very heavy crypto user, like we have some users that are making 800, 900, 1 million transactions every year. They have automated bots. They're doing margin trading, staking, lending, like they're going through the whole gamut of what crypto has to offer. So we can support them as well. So, we can support anyone from your average mom and pop to your quote unquote crypto whale and anywhere in between.
And so I guess you just described who your ideal user would be based on the various tiers, but who would be someone that wouldn't benefit from Zen Ledger's service?
Someone that doesn't have crypto activity. So that's something like we don't offer. We're not necessarily trying to compete with like a TurboTax right now, in the sense that like if you have a W-2 or a K-1, or if you're trading some stocks and bonds on TD Ameritrade or Schwab, like that's not really our audience. We don't support like traditional stocks, bonds, equities, commodities, anything like that. So anyone that's not using crypto is definitely not going to be a customer. I'd say anyone within crypto is pretty much a customer because of the level of integrations that we have. So like I said, if you're using like a Coinbase, a Binance, a Gemini, like a very high level, kind of easy to use exchange, you're making a few trades here and there, we can help you out. If you're getting like really deep down the rabbit hole, you're trading NFTs, you're using DeFi, you're using lending, staking, margin trading, like getting very complex, we can help you out as well. So I think that's like the nice thing is we can really help out anyone that's trading any type of activity within crypto. And that helps with income as well. So let's say, you bought 1 Bitcoin on Coinbase, you put it into BlockFi or Celsius or Nexo, which are platforms that allow you to earn interest on your holdings. So we can help you with your taxable income, your capital gains. If you have any foreign account reporting as well. So if you need to file an FBAR or FACTA, we also provide like a granular fund accounting spreadsheet, a tax loss harvesting spreadsheet, so you can sell assets that you hold at a loss to offset any gain. So I guess my long-winded answer to that is pretty much anyone that's using crypto is a customer for us, and anyone that's not in crypto is not really someone that we're able to support at this time.
And I guess, how long would it take? Like, let's say I signed up for Zen Ledger today, and let's say I'm not a massive power user, I'm not running bots, but I'm doing some yield farming and I'm providing some liquidity. Is it like I just provide my wallet addresses and, a day later or 30 seconds later, I get all my tax information, or what's the process like?
Yeah, great question. And I think that goes back to like the team and the integrations and the amount of, work that we've done over the last, couple of years of, investing millions of dollars into that IP. Is we now support over 400 different exchanges, over 8,000 different token types, every single wallet type, and about 30 different DeFi protocols. So the ability to ingest and integrate that data is really easy. So for an average user, you'd come on, you sign up, create an account. Then we'll have an import tab. On the import tab, you'll select your exchanges, select your wallet. So let's say you have a Coinbase, Binance, KuCoin, Gemini. Then you have a MetaMask, a Ledger, a KeepKey, and some other wallet. You just, on the exchange side, most of the time we'll have an API key, an API integration. So you create an API key, an API secret, and then we'd ingest that data. And it's all read-only access. So we don't have access to like your accounts. We can't move your funds. We can't log in on like your behalf, like nothing like that. But that gives us the ability to ingest all of your historical data at once. So it's not like you have to do that every quarter, every month, every year. You do that once. So let's say you have activity back in 2017, 18, 19, 20, and you import your Coinbase API, we'll automatically be able to parse out and say, here's your tax return for 17, 18, 19, 20, and 21. So yeah, so I guess to answer your question, you just come in, you'd import your exchange accounts, you'd import your wallets, and then our software really automates all the rest for you. You just click next step and then click tax calculation. And depending on the volume of trades, if you have 5-10 trades, it'll be like 5 seconds. If you have 500,000 trades, it may take 15-20 minutes. So it kind of just depends on like the complexity, not really complexity, but like the volume of trade activity that you have.
And then with that data, do I just go to my normal, because let's just assume I trade normal stocks as well.
Yeah.
Do I give it to, I don't use TurboTax. So would I give it to TurboTax, or would I just give it to my accountant in this case? Or do you just tell me how much I owe and then?
Yeah, great question. So we are a TurboTax Premier partner, and that's another kind of one of those moats where they only selected 5 partners to work with, and they're not accepting any more. So that's kind of another like nice advantage is if you're a TurboTax user, you can, when it comes to the crypto question, you can select ZenLedger as one of the little tiles. You can drag and drop our forms right in. Then you can upload your K1, your W2, your 1099, like whatever other activity you have, and then you're in, you're out, you're done. Additionally, we allow our customers to download their tax forms. So if they're self-filing, you can come in, you can download your forms, you can attach them with your own filings and be done. We also allow for you to invite your accountant in at no additional cost to you or your accountant. So you just click on the Tax Pro tab. Let's say you're working with Mike Smith. You just type in Mike Smith at gmail.com. They'll get a nice little email that says, hey, Paul is inviting you into his ZenLedger account. And the good thing for our tax professionals is a lot of tax professionals don't want to understand about crypto. They don't care about crypto. They have they don't really care about Bitcoin, Ethereum, any of the rest, but they do understand what 8949 is. They understand what a Schedule 1 is. They understand what a Schedule D is. So the fact that they can log on and simply download your tax forms, include that with the rest of your tax information is super easy to use, and it's no cost to you or to them. So we have about 1,800 different tax professional firms using our software to power their crypto practice. And so that's been a really amazing kind of second half of our business is really allowing tax professionals to get up to speed and be able to handle and kind of be the go-to provider. And then the final piece that I would mention is, in addition to all of those activities, we also offer tax professionals on staff that can handle your crypto and non-crypto activity. It's a little bit pricier than using our do-it-yourself options, which range from $0 to $399 per year. Our tax pro plans range from $750 to $2,500 per year. But in that package, you're actually buying tax professional time. You're sitting down with a tax professional. They're handling your import. They're handling your filing. They're signing off on your paperwork. So you're kind of buying like audit protection in that sense. And they can handle all your crypto and non-crypto activity as well. So there's kind of a few different options depending on if you're self-filing, if you're using TurboTax or H&R Block or like a tax act, if you have an accountant or if you need an accountant. So we can kind of really help you out wherever you sit on that spectrum.
What would you say? And by the way, if anyone in the crowd has any questions for Dan, please just pop them into the chat and I'd be happy to ask them. But what would you say to, like, let's say, a long-term holder of crypto, Bitcoin, they bought Bitcoin at $200 and maybe they poke around, they poked around in DeFi and stuff, but they haven't actually filed any taxes here. And it's been years and they're actually scared to do so because they're scared about the money they might owe or whatever. What would you say to that user?
Yeah, I mean, to that user, what we would recommend is definitely to work with a tax professional. Obviously, as I mentioned, we have tax professionals on staff. So this is not necessarily like a Zen Ledger show where you have to work with us. But working with someone who is going to be able to really steer you in the right direction is going to be super valuable. From a Zen Ledger specific perspective, we can provide tax reports back to 2012. So if you got in, early or 15, 16, 17, we can really help you with those tax forms, and you can file an amendment and get those nice and clean and ready to go. So, from a high level perspective, it's definitely the sooner you get compliant, the better. There's kind of like not anymore, but in 2017, 18, there was really kind of this like theory that like crypto tax is anonymous and like they don't know how to track any of this stuff. And the IRS would never come calling and like you can trade as much as you want and like, make as much money as you want and you'll never have to pay a cent. That's like, it's been proven false. The IRS is investing, millions of dollars into crypto tax software and into blockchain analytics software. So one thing that they just launched, maybe we can link in the show notes, is a joint task force called Operation Hidden Treasure. And that's kind of an announcement of what the IRS has been working on for the last 18 months of multiple units within the IRS that are coming together that have been sitting here like looking at this information for quite some time. So the ability to kind of run away or hide or not have to file it is not there. And the sooner you get up to date, the sooner you can be compliant is the better. And if you're going to start filing now, like we have that question now, it's like, okay, well, I didn't file in 17, 18, 19. I want to file today and I want to file moving forward, but should I file the past years? Like, if they see a 2020 tax report that says you made $300,000 and your income in like, typical income's like 50 grand a year, they're going to want to know where that came from. And if they see, and that's the thing with the blockchain is you can see what came in, what came out. So they can see that you bought that Bitcoin back in 17 and you sold it in 18. And if you didn't file in 18, 19, 20, they're going to, it's not necessarily like an automatic audit, but like it's a pretty big red flag that like they might take a deeper look. So I guess my answer to that is, one, I would work with a tax professional. Two, if you need one, we can obviously help you out. And three, it's definitely a scary thing, but the sooner you get it, the better. It's like having a cavity and knowing that, if you let it sit there for 2 years, yeah, like your tooth is probably going to rot out and it's going to be a much bigger issue than just going in and getting a filling.
Do you have to pay a penalty? Like is there a penalty or is it like a grace period sort of thing where it's like, great, you've reported, you just pay what's stipulated, or is there like a penalty tax because you haven't filed for 6 years or whatever?
Yeah, great question. So there's not really like clear guidance on that yet. So it's not like, okay, you didn't file in 18, you now owe like a 10%, like late fee or something like that. So there's not very clear guidance. We have seen that the IRS is more concerned with people, and this is something we can talk about of last year. They moved the question of have you interacted with digital currency to the Schedule 1. So that was new for last year. And this year it's now on the top of the 1040. So every single US American and tax professional now has to check off if they've ever interacted with cryptocurrency. And that's kind of like, that's a big deal because if you say no and it's yes, that's like literally like a felony. You're committing perjury. You are like clearly trying to avoid taxes and you're going to have some deep issues. But I guess the answer to that is there's not like necessarily like a specific penalty or a fee or percent that you owe for every day or anything like that. This is not necessarily like tax advice per se, but like the sooner you come clean and get up to date, the better. And I think we're going to start seeing that the IRS is going to start focusing on the most egregious cases where people are making 6, 7, 8, 9 figures and they're not paying at all. And they're like clearly trying to avoid paying. Then like, Joe Smith who made 20 grand and like didn't know that he needed to pay or something like that. Like, I'm not saying that there's no risk involved, but I think
they go after the big fish to make an example. One thing that I think is super interesting that you talked about was that the IRS is starting to invest more in analytics in the crypto space. So I'd like to, like, I don't know how much you know, and I don't know how much is public, but like, are they going to be running their own full Bitcoin node, full Ethereum node? Right. Like, I'm just curious about how they're going about, because like it's another technical step that the IRS needs to learn, and they're like the biggest moneymaker in the United States for the US government. So I'm just curious, like, is that what they're going to be doing, or are they paying someone like Chainalysis, or are they just spinning up their own firm, so to speak?
Yeah, I mean, it's a little bit of both. So the first tax guidance that we got in the US was actually back in 2014. And that's a question that we get all the time. It's like, I didn't know I needed to file in 17 and 18, and not knowing is like never like, it never gets you out of not doing. So that's one thing that a lot of people don't know is, it's called 2014-21. And that was the first IRS guidance that clarified that they're going to treat crypto as property, which kind of creates the whole issue that we're into now. Like they treat it as a currency or commodity, totally different ballgame than treating it as property. But anyway, so the IRS is like stated, 7 years ago that this is how crypto is going to be taxed. Here's what you need to do to be compliant, et cetera. As far as what they're doing to date, there's obviously some things that I can and cannot say. And a lot of the stuff that we do that's more B2G or business to government related or falls in that realm of not being able to say. What I can say is that they have been looking at this stuff for quite some time. And what the IRS wants to do and most government agencies wants to do is really understand that when they bring someone to court, that these numbers are going to be accurate and that they have a real case that they can bring. They're not going to try, especially early on, they're not going to try to bring someone to court, say that you owe $5 million and lose the case. They're going to make sure that it's rock solid. They're going to make sure that they're going to win. And then they're going to use that to go, make sure that other people know that there's consequences. So I guess what I can say is that the IRS has been investing millions of dollars into crypto tax software, into crypto tax analysis, and into blockchain analytics, like an elliptic, a cipher trace, a chain analysis. And then they're using the combinations of those platforms to really be able to put together a comprehensive report on an individual. So the trend
that's fascinating because someone might report 5 wallets when they really have 20 and pay $1 million in tax when in reality they owe 20. And so that's the type of questions that I'm sure a skeptic would ask, is you'd be like, well, is the IRS really going to be analyzing the relationship between 30 different wallet addresses, et cetera, et cetera? I guess that I don't know, that's fun, sort of super under the radar. And I guess there's, more to come in the future from the IRS on that. Would you say that the IRS is, because there's a really interesting article, and I'll have to dig it up, but it was an article about how the IRS, compared to other tax authorities around the world, is actually incredibly efficient at collecting money. They're incredibly successful when you compare it to other tax authorities in practically every other country in the world. But related to the IRS, are they sort of the most advanced in this space in terms of the like capital they're allocating and time to understanding this space versus other tax authorities like abroad?
Yeah, definitely think the IRS has made it clear that they are going to get what's theirs, and you can see that in pretty much every other industry. And we saw that most recently with some of the Obama administration of kind of like the Swiss account crackdowns and like all these types of stuff. And that's one thing that I think people are another thing that's kind of floating under the radar is when you look at the last 4 years in the administration, and I'm not a very political person, but like when you look at like what the priorities were, tax compliance, money laundering, white collar crime, it's probably not as important under the Trump administration as under the Biden administration. So like just having like an administration staff that is like that cares about this stuff is going to be big. And having a unified government is really big as well. And that's not saying that red or blue or whatever is like the right way, but like having a government that is not always battling with each other to get new guidance, new legislation involved is going to be good for the space because we'll actually get clear answers. And right now we're kind of in this opaque gray area.
Yeah.
But anyways, to answer your question, on the IRS side, I think the United States has made it very clear that they're taking tax evasion and tax collection very seriously, not only in crypto, but outside of crypto. One thing that people don't understand is that if you're a U.S. citizen and you're residing in any other country, you're still paying U.S. tax. If you're a dual citizen, a U.S. citizen and a French citizen, you're paying U.S. tax. Like, so the U.S. takes domicile and control over, if you're a U.S. citizen, you're paying the U.S., and there's not really any ifs, ands, buts. Like, obviously the amount that you pay, there's some stuff that you can do to try to minimize the burden, but like you're paying. So yeah, the IRS is definitely taking this seriously. They're investing. They're now starting to invest, considerable amount of money in the crypto space to look like they see. They're not ignorant. They see a $1.5 trillion market cap, and they see that there's like 80 to 100,000 people that file taxes. Like the numbers don't add up. Like they know that there's a lot of people out there that aren't filing, that need to file. And we've seen obviously with John McAfee, which is like a huge case, where the IRS and the SEC are now extraditing him from another country, bringing him in on multiple charges. That's going to be kind of like that Al Capone moment in crypto, where it's like you can't run away, even if you're some like billionaire who's living on a boat in the middle of the like they're coming to get you. So yeah, I would definitely
it's interesting because I don't think I pay I'm a French citizen as well. I don't think I pay French. It's interesting. It doesn't work the other way. I don't think I pay French taxes. I pay U.S. taxes, but I don't think it works the other way, which I guess goes to show that the IRS is just great at collecting money. But I guess it's a good segue to talk about the current rules and taxation of cryptocurrency. Do you think that one of the main reasons to usability, we at DLab, we think a big problem of the mass adoption of crypto is the usability, and part of that's the UI, the UX, because it's super clunky. But do you also believe that part of the hindrance to usability and mass, the masses using it is the current tax rules around it?
I think in some regards, yes, but in some regards, I think it's kind of like an overblown concern. Like I think the vast majority of people, if anything, are less concerned about the taxes, and I think the compliance rate shows, than they are about how to use these things. So like, I definitely think like the UI, the UX is big, and then also like the capital and what you can do with your funds is huge. So like we saw, back in 2017, we saw the ICO craze, which led to all these increased prices, a ton of human capital, a ton of actual capital come into the space. We've seen the same thing over the last probably 12 months with DeFi and NFTs specifically. I think Beeple just sold like a collection of his artwork for like $70 million.
Yeah, wild.
Like,
yeah.
NFTs, DeFi, like so much money to be made. So we're seeing more like when people know that there's money to be made, they're willing to play along with the clunky UI and UX because they're going to make a lot of money. So it's like giving them a reason to use crypto is super big. So I don't think that the crypto taxation has really been a hindrance to people using crypto. The only thing that may be kind of in that category would be from using crypto to purchase goods and items. So like if I'm trying to use like Bitcoin to purchase coffee, it doesn't really make sense. One, because most people investing in Bitcoin are using it as a store of value. And, why would you spend that money when you can spend dollars, which is, kind of going down day by day. And then two, anytime you use crypto to purchase a good, a service, that's a taxable event. So I think that part of crypto taxation could definitely be improved. Us, along with some other firms like a Coin Center, who's kind of like a public advocacy group in crypto, have been asking for like a de minimis rule where you can spend up to a certain amount of crypto and there's like no taxable event involved. So I think that's kind of a big item, but like the other items aren't as big. Obviously, with crypto being treated as property, anytime you make a trade from one crypto to another, that's a taxable event. So Bitcoin to ETH to DAI to USDC, anything like that is all taxable. So you could make an argument that if it was a commodity, it wouldn't be treated in the same way that it would be as it being treated as property. So I guess that's the other kind of argument.
So if we could unpack that just a little bit. So the current taxation, just for our listeners, the current taxation is the way I understand it. It's being taxed as a piece of property. So if I sell from one house to another, for example, that's a taxable event and I need to pay capital gains on it. Although, I mean, someone in the crowd might say that there's an exception. I think it's a 1099. What is the exception where you sell one house and whatever? We're getting into in the weeds on tax, but you know what I'm talking.
Like-kind exchanges.
Like-kind exchanges, but there doesn't exist like-kind exchanges in crypto, correct? Like, Bitcoin and ETH, I would argue they're like-kind, but in the eyes of the IRS, they're not. So every single time, whether it's, 1 Satoshi or, 10 ETH, whatever you're transferring, it's a taxable event. And I guess that's different from how stocks are treated, right? Like if I'm trading in between stocks currently, I'm trading from Apple to Berkshire Hathaway. Or is that similar, I guess?
It's pretty similar to like stocks in the sense from like a capital gains and income perspective.
Yeah.
So it's not that much different. It's really just like the three main buckets to kind of look at from like a high level perspective into crypto taxes is anytime you go from dollars into crypto. So, I put $100 into Coinbase, I buy Bitcoin with it. There's no taxable event at all. So dollars into crypto, good to go. No taxable event. Crypto into crypto, pretty much anything crypto to crypto, Bitcoin to ETH to whatever. Capital gain, most like, or capital loss, like you could lose money on it. but some type of taxable event. And then going from crypto back into fiat, taxable event is, if you sell your Bitcoin back into dollars, ETH back into dollars, taxable event. So those are kind of like the three main buckets that most people fall into is I put money into crypto, there's no taxable event. I then traded some crypto for another taxable event, and then I sold my crypto back into fiat, taxable event. And then obviously there's other things within crypto that make it not challenging, but just different. Like there's airdrops and forks, which are kind of like dividends for stocks, where like you can actually receive capital from just owning an asset. But that'd be ordinary income and be reported on your Schedule 1. So there's some kind of outliers that happen in crypto that aren't as like, there's no real like clear one-to-one parallel with like stocks or bonds. But from a high level, like stocks and bonds are treated the same way as a capital asset and as you'd have to pay on capital gains and capital losses.
So I guess, when you say that it would be better for cryptocurrencies to be taxed as a currency, unpacking that a little bit, don't I pay, if I wanted to go from dollars to euros, isn't that a capital gains? Isn't that an event or no?
So yeah, so under Forex, you can go in between like foreign exchange currencies, and there's no like capital gain or capital event at that time until you go back into the native currency.
Oh, I see. So if I go to dollars at $10, I spend $10 to get 10 euro. Let's just assume it's 1-to-1.
Yeah.
And then I come back 6 months later and I exchange my euros for $20. I have to realize a gain.
Yeah. So pretty much like they don't.
Even though that would mean that the euro is weaker, right? Okay, sorry, I'm doing it in my head. I thought it was an inverse relationship. But I have to pay tax, so I'd have to pay taxable gains in that sense.
Yeah, so pretty much with like Forex, you pay on like the end, so you don't pay what happened in the middle. So you can do like a bajillion trades, go USD to euro, euro to yen, yen to whatever else is out there, and like just make as many things as you want. But then when you go back into that native currency, then you pay like, oh, okay, so I started with $10. I now have
I see. It's like a sandbox, basically.
Yeah, it's like go have fun, go play around. But when you come back and you exit that sandbox, you need to dust yourself off and give us our sand back.
Yeah, okay, that makes sense. And so that's logical how that would be beneficial to crypto, because boom, you go into crypto, boom, you mess around, come back to dollars, you have to pay this. But I guess the question I would ask is, what if we move on into the future, 5-10 years, where I don't actually have to cash out to fiat. I can start using stuff. I guess the tax laws would have to change a bit, but is that where tax laws are going towards? Is that where it seems like they're going in terms of taxing crypto as currencies, where it's like that sandbox, or super unclear? Where does it look like it's going?
I think obviously very unclear. I mean, we've had, like I mentioned, the 2014-21 is like really the best set of guidance that we have. And that was 7 years ago. We've had like a little kind of snippets here and there that's like, okay, this is this. Like just this year, that movement from the Schedule 1 to the top of the 1040, we just got guidance that if you've purchased crypto using dollars, you don't have to report that as yes. So you can say no on that 1040 question, even though you've actually bought cryptocurrency, but you didn't trade or anything like that. So we're getting like small snippets of guidance. I think, as we mentioned earlier, like having a unified government and having a government that probably cares more about tax evasion, white collar crime, money laundering than the previous administration, I think we'll start seeing more and more guidance. As the IRS continues to provide enforcement, they have to provide the rules of the game. And I think that's why a lot of people get kind of annoyed. And there's a lot of questions around DeFi, NFTs, like how are these taxed? And you kind of have to make your best educated guess and make a conservative outlook on here's how you can kind of draw a parallel to other aspects. But there's no like IRS DeFi guy that's like, here's how like this is taxed. It's like, we don't know. It's like very gray, very opaque. We have to make our best like educated guess. So yeah, I think we're definitely due for updated guidance on the whole ecosystem. I'd be personally, and I've been wrong many times, I'd be personally very shocked if they moved it from property into currency. I think we're 7 years down the road. Like I think it'd take a lot for them to do that. Then you'd have to go through the 150,000 people that have already filed under property and try to figure out how to make them whole. Like it's too much confusion. I think it'll stay as property, but I think we'll get better guidance and better legislation around using your crypto. So like that de minimis rule, like you said, maybe you don't have to go back into fiat. I put fiat into ETH. I use my ETH to go to Starbucks, Subway, whatever, and I buy a sandwich, I buy a coffee, and I didn't go back into dollars, but I could, up to $600 or something, or $1,000, there'd be no taxable event. So you'd be done, you'd be good. But right now, you'd have to report that event. You'd have to file taxes based on when you bought that ETH, when you sold the ETH, because you're selling the ETH to buy the coffee. So like, I guess, long story short, I don't think we'll see a movement from property into currency, but I think we'll see better legislation, better guidance, and more clear direction on some of these kind of outlier issues within crypto tax at the moment.
Yeah. And I would imagine that the problem is kind of compounded here. Like we've more so focused on our discussion on individuals, but I would imagine your problem is kind of compounded here if you're like a crypto native startup and you don't even deal with fiat, but you're based in the US, for example. I feel like that must be a massive headache, because what if you're never actually cashing out? Like a lot of crypto fund startups pay their employees in USDC or something, right?
Yeah.
So the companies themselves, I guess it's like they're passing down a K1 to their employees or something, or what are they doing?
Yeah, it gets a little complex when you're like kind of crypto native, whether you're a fund or like a business. So there's a lot of businesses now that like accept crypto, they raise capital in an ICO or some type of
they never actually raise fiat, and they never actually that's right. I forgot about that too, right? Like they raise money in USDC, so it's like they never interesting. Yeah.
It gets a little complex, but that's kind of like some of the use cases that we can now kind of go after and tackle. But for us, like that wasn't how we were going to be $100 million billion business. It's like trying to solve that for them at the moment. It was like, let's solve retail, and then using our retail like prowess, we can then go solve that issue very easy for them, because it's like the amount of activity isn't as much. So like, like maybe you raised $5 million in an ICO, but you can see, okay, all that money was raised on this date at this time at this cost basis. And then each time you use to pay payroll, to pay expenses, to pay whatever, we can see what price that was, the USD value, where it went, and those types of things. So, it's definitely like a little complex, but it's not like there's not solutions for that. And there's other companies in the crypto tax and accounting space that are focused, like their whole business is focused just on the businesses and the funds. We just personally thought that the retail market would be a much larger market and would allow us to get into that instead of trying to go for that first and then into retail.
Yeah, that seems like a much harder problem, and definitely certainly much more niche at the moment, whereas here it's like your user could anyway. I guess this is, I guess, a good point to jump into like tax specific questions I have. I guess the first question I have, and I'll actually share a tweet that I thought will outline this problem, but I thought it was hilarious. This tweet, I don't know if you saw this tweet on Flash Loans.
Yeah, there's like I said, there's
so how are Flash Loans, you know what I mean, in this example, borrowed 150 million 1,000 times, totaled 150 billion borrowed, and your income's 100K. So, in that scenario, how are Flash Loans treated, for example?
Yeah, so we're starting to see kind of the outliers and the bell curve kind of shift to like more complex financial instruments. But like the way we look at it is really from, there's a very, very small subset of users that are using these advanced things, whether it's even margin trading, which like, depending on where you sit on the spectrum, your risk tolerance like may be very complex for you. But like for a lot of people, like margin trading is not that like complex, but like the amount of people that use margin trading in crypto is like very small. Then you get into DeFi, which is even smaller. Then NFTs, which is even smaller. Then like Flash Loans, very, very small. Then derivatives and options. Like you get very like there's probably less than five, like I don't even know, maybe 2,500 people in the entire world that are using crypto Flash Loans. Like it's very, very, very small.
Well, so I actually, like, it occurs to me, because you read articles on the internet all the time. There's 50,000 people in DeFi. There's 10,000 people using Uniswap. It occurs to me that actually your firm would actually be probably a better source of truth than just looking at the Ethereum blockchain, seeing how many active wallets there are, and making a guesstimate like, okay, maybe everyone has 3 wallets, so there's 50,000. So it occurs to me, because I know you said earlier your average user is 8 to 10 wallets. Would you say that's common throughout all of cryptos? And I assume you deal with just US individuals, but would you say that's just common across the world?
I think so. I mean, I think like the average user, whether it's a ZenLedger user or like a crypto user, is using multiple exchanges, multiple wallets. And that's really where like the ZenLedger platform solves them a lot of time and headache. So yeah, I think like the average user is using not only multiple wallets, like as far as like different wallets, but even like multiple addresses. So like one thing that like became like pretty apparent is like Uniswap, which is a automated market maker, which allows people to swap tokens and provide liquidity for different pools. That may sound like complete like la language, but like once you dive down the rabbit hole in crypto a little bit, Uniswap is like a really cool company, really cool platform and protocol. But anyways, one thing that we saw with Uniswap.
Yeah. Sorry, no, go ahead.
Oh, so just like the one thing with Uniswap is like what they did is after the fact of building out this really amazing protocol and getting a lot of liquidity on it, they did a retroactive airdrop to users that interacted with the protocol. But the airdrop went to singular wallet addresses, not necessarily like the owner of the address. So like I could have a MetaMask account with 15 different 0x123, 0x124, 0x128. Like I could have 15 different wallet addresses within my MetaMask account and interact with Uniswap. And I would have gotten 4,000 Uniswap per address. So that's the other thing. It's like you can have, I could have a MetaMask, a Ledger, a Trezor, a KeepKey, my Ethereum wallet, but I could also have like 15 addresses per each. So like you can get super into the weeds a little bit.
Of course. I guess my question would be, how many people do you think are using DeFi today? Because I'm always curious on, if you had.
I'd say probably that 50,000 number seems probably about accurate. I don't think that there's that many people.
No, that's fascinating because you look at other you search on the internet, for example, and it says we have 1 million plus, which I there's no way I believe that. I have zero. I even think, I think any number of 100,000 is pushing it, but that's interesting. This just occurred to me that you guys would be like a great source of truth into how many true users there are.
That's one of the like strategic advantages that we have, and that's what's going to be coming down the pipeline. It's like when you look at like an aggregator for the perspective of like crypto, there's aggregators that aggregate crypto transactions and want to aggregate and kind of compete against central banks and traditional banks and things like that. But we want to kind of be like an aggregator in the sense of being a bridge for financing crypto. So we're not here to tear down Wells Fargo. Like we're here to help people be compliant in crypto tax. But in crypto tax, we're like the only solution that you're using that you have to aggregate all of your activity. So like if I use MetaMask, if I use Uniswap, if I use SushiSwap, if I use like any of these platforms, I can interact with that with one address. They don't even know who I am. Like you very fragmented. To get your complete tax perspective, you have to import and annotate all of your activity. So from like a data set perspective, like we can see what everyone's doing and what they're doing, when they're trading, what they're using. And with that, we can build out, other functionality within the tax platform. So like, I don't know if you're familiar with like Adapar.
I am
like,
actually, yeah.
Or like Fidelity, like we can be that in crypto. So we have the highest touch point of getting all your addresses, all your wallets, all your exchanges, all of your annotations, everything that you've ever done in one platform. And once we have that information, we can show, hey, here's some really great research. Here's really great trade execution. Here's really great this. So we can start being a central hub and a spoke for all other types of things.
Yeah, I see what you mean. I guess not to delve. I mean, that's super interesting. And I always thought a platform like that is super interesting because in my not previous to this, when I was working at DLO, I was working at Morgan Stanley. But prior to that, I was working at a family office and we had a wide range of assets, right? Private, public stocks, publicly traded bonds, currencies, but also real estate and privately held businesses, et cetera, et cetera. But where those platforms fail, and I don't know if it's a solvable problem, and we're getting a little off topic, but is reporting, the markup, markdown of these privately held assets. One, like this property, but also two, like your LP position. And this is where I think actually blockchain could be interesting because your LP position in a private equity firm or venture capital firm, because there's capital calls, there's fees, all these things happen on a quarterly basis. And anyway, that type of stuff, when we were looking at Adapar and other services similar, I'm not just picking on Adapar, but that's where they really were inadequate. And we ended up building something ourselves because but anyway, but that's super fascinating because investors want something like that. But I think that's an interesting use case for blockchain on the private LP side in funds and for the accounting side. Anyway, I guess getting back to the crypto specific questions on tax I had, I guess, if you're using margin trading, for example, right? Am I correct? And I couldn't remember this from my days working at Morgan Stanley, but can you write off the interest rate? Like if I wanted to trade Apple on margin or GameStop, whatever, can I write that interest rate off on taxes or no?
So not necessarily like a write-off, but you can roll it into your cost basis. So
okay.
like,
And can you do the same in cryptos? I guess is my question.
So I guess that answer was to be for crypto. I'm not sure how it is in stocks. That's a fun thing that I get all the time of like some of these like deep accounting questions. I'm like, I'm not an accountant. I just run an accounting firm. So yeah, for crypto, you can roll that into the cost. Same thing with like a gas fee. So that's a question we get all the time of like, I bought ETH, I sent ETH to Uniswap and I paid $50 to have my transaction settle. That gas fee can be rolled back into your cost basis, which can minimize the gain that you could have. So there's definitely some like kind of, you can get very strategic, and those are things that we do naturally in the platform. So that's not like you don't have to go in and manually select that. Like we automatically do that for you. So anyways, yeah, with margin trading, we support about, I think 8 or 10 different margin trading platforms like natively. So you enter in your API key, your CSV, and we handle all of it. Margin trader fee, rollover, margin trading liquidation, margin trading. Like if you have to re-up your balance to keep that margin open, like we can kind of see all that. And kind of going back to your out-of-part question, like the difference between some of those things in traditional finance and crypto is everything happens on chain. So we can see everything that happened, like where it was sent, where it went, where it was received, how much it was. And like, obviously we need to like use pricing aggregators to see the USD value of that price, but we can see all that stuff is public. And that goes back to like your question around how is IRS going to figure, like it's all there. It's like having a treasure map, and they're just now trying to figure out like the legend of the map. But anyway, so like margin trading is something that we can handle pretty natively, and you can just import like a Kraken CSV file if you do margin trading on Kraken, and then those interest rates or like a gas fee can be rolled into your cost basis, which could help minimize any type of gain that you have from that event.
And what about if you want to provide it like to a liquidity pool on Uniswap or something? I guess in permanent loss, but I hate calling it impermanent loss. I read about a better name that I think is more apt, but I guess that gets just treated as a regular loss, right? There's nothing special about it. Is the interest received, is that taxable as income, or is that just like a cap gain every time?
Yeah. So with DeFi, one of the things that we talked about is like we don't have clear guidance from the IRS. It's like this is what's going to happen. So we have to make like educated parallels to what happens in other industries. So typically with like DeFi, like the one of the big questions is like, if I'm getting a wrapped asset or a liquidity pool token, am I getting a new token, or is this like a subset of the token that I'm providing? And under like conservative guidance, pretty much anytime you have one token and you get another one, whether it's using compound and getting C tokens, or Aave using A tokens, like anytime you get one other token or one other piece of property for another, there's going to be a taxable event there. And until the IRS says like that's not the case, that's what we're going to default to is like conservative. Here's like the worst case scenario. Like you can go try to figure it out with a tax professional. Like that's on you. But anyway, so like the lack of guidance kind of creates some of these issues and questions in DeFi. It's not really like the lack of like tech, like it's not the tech stack that's lacking for us to like figure out what's going on. It's like, how should this be treated? But anyway, so really like when you supply liquidity and you get like an LP token, that would basically be a capital event when that happens. And then the interest or income that you earn would be ordinary income based on your tax bracket. So you can have capital gains, which would be typically on your 89 and 49. And then on your like ordinary income, you have your Schedule 1 and your Schedule D, which will list, airdrops, forks, interest if you're using BlockFi or Celsius or Nexo, or earning interest from, lending out your crypto or something like that. So you in DeFi, largely 99.9% of everything is either a capital gain or ordinary income. And the good thing with using a platform like ours, not to show ZenLedger every 2 seconds, but like you can just import a wallet address, and we'll automatically segregate that out for you and say, hey, here's your 8949, here's all the taxable events that you had, here's all the income that you earned, then you're done. And then as we went through earlier, you can put that right into TurboTax, put it into your accountant, do whatever you need to do. So we can automate a lot of that like frustration and chaos out for you.
So it's not just about getting like a C token, but in the event, like let's say I'm on Gemini, and Gemini now it's Coinbase, Gemini Earn. And I think when I was reading the disclaimers, they're using Genesis. It's like the disclaimers were insanely long, but they're using Genesis. So they're sending my Bitcoin to Genesis. If I go from one wallet address to another, that's not a taxable event, right?
Correct.
Yeah. So I send it to, yeah. Well, I guess technically I think it's an address Genesis owns technically. So that's a little, I don't, I couldn't really,
but pretty much like if I have a Coinbase account and a BlockFi account, I send funds from Coinbase to BlockFi, no taxable event. But what happens in BlockFi or in Coinbase Earn or any of these platforms like that are, I mean, pretty much they all do the same thing. Nexus, Celsius, BlockFi, like they're all lending your capital out to Genesis, to OTC trading desk. They're buying, Grayscale, GBTC, and then selling the premium and giving you half the, like, when you're getting yield or interest, like there's risk and they're making more than they're paying you and you're getting like the spread. But anyways, yeah. So like sending your capital from a Coinbase to a BlockFi, Coinbase to Gemini, Gemini to Ledger, Ledger to Trezor, any of those are non-taxable. But that's one thing that a big question that we get all the time in crypto tax is like, well, if they're non-taxable, why do I have to report them? And you don't actually report the transactions themselves, but you need to put them into ZenLedger or a crypto tax software that you use so that we can see those movements and say that they're non-taxable and show that this was your cost basis. And if you're using FIFO or HIFO or LIFO, the actual tokens that you're selling can be widely different, based on where you have them and where they're located.
Yeah. So if I'm if I'm doing Gemini Earn and I'm getting whatever 3% of my Bitcoin, that Bitcoin that I'm getting right in yield is taxable at ordinary income, right?
Correct.
But aren't I also at a later date paying taxes again? Because if I wanted to sell that yield I got to dollars, I'd be paying a double tax. Yeah, capital gains.
Pretty much. Wow. So that's the fun part is like, if you put USDC onto Celsius or BlockFi and you're earning interest on that account, like all that interest that you're earning would be taxable income at your ordinary income tax rate. And then, same thing with like capital gains, you have short-term and long-term capital gains. So if you hold those assets for over 12 months, you're in a much better position than if you sell them in 2 weeks or 2 months. But yeah, so you can definitely run into some complex issues.
It's funny. I'm doing the math in my head because it's like, all right, great. I'm getting a 3% yield, but if I'm paying ordinary income, but then at a certain point, let's say I pay long-term cap gains, my net after-tax yield is probably like 1% or even less, Anyway.
It gets like, I mean, that's like one thing that we're now starting to see in addition to like, we talked about individual investors and how like they're starting to get up to date. We talked about the IRS and how they're starting to enforce crypto. One thing that we're seeing right now is like the service providers. Like we partnered with Abra about 3 months ago to be their exclusive crypto tax partner because they needed someone to help provide 1099 miscellaneous. And they have all these questions from all these providers. All their customers are like, what am I doing? How do I get this done? So we're now starting to see like our biz dev efforts like 4 years ago were like, hey, you're going to need to know about this. Like you're going to need to care. Your customers need this. And they're just like, we don't care. And then Coinbase got sued by the IRS. And that kind of like sped up the acceleration process. We're like, oh, we kind of need to care. And I'd rather just like use a platform or partner with a platform like ZenLedger than pay a $1.5 million fine. So we're now starting to see that next wave of acceleration where like the BlockFis, the Nexos, the Celsiuses, the Geminis, like the actual platforms and protocols are now going to have to like start figuring out. Same thing with DeFi. Like if you're using Uniswap's going to have to start sending out 1099 miscellaneous for all the people that earn it. And it's going to be like, it's just going to be a nightmare. And like,
how would they do that though? How would they do that?
Yeah. I mean, they would just send it like, so it depends on like the level of DeFi that you get into. So like,
well, I mean, how would Uniswap, well, I guess, might be discussion for later, but let's say Uniswap was like, fuck, we need to send 1099s to our users. They just have wallet addresses.
Yeah. So that's the thing that gets like complicated and like how far down the DeFi spectrum you get. Like the Uniswaps, the compounds that have raised venture capital are probably going to be more likely to go the compliant route versus like a sushi swap that has like a crypto avatar guy that like is not really going to care. So it's like how the company or protocol is structured and like how it was formulated is going to make a big difference on how compliant they are. So it's definitely like there's a lot of
or questions. I guess what they could do is tax withholding, right? They could just withhold taxes. You could say that you're a US, you could, I guess, indicate that you're a US citizen and check tax withholding. And I guess Uniswap could hold the taxes and then just pay the government that way.
There's
Anyway, I'm just thinking out loud. I have no idea.
There's a lot of like unknowns, and like one thing that we've heard that maybe like a new legislation or regulation is like having KYC and AML for DeFi protocols and platforms. So it's like if a Uniswap doesn't want a KYC or AML, like the government can go after Hayden, who's a person with a company with a corporation, and like they're gonna have a lot better time making that happen than going after OX Maki and some random avatar guy on SushiSwap. Like, so I think, like we talked about, the IRS they're going to be coming after, and that's not meant to be like a scare tactic. They're going to be coming after like individuals, platforms, providers. Like they're going to now in the next like 18, 24, 36 months, we're going to start seeing a lot more traction on like crypto tax compliance. And obviously that's not the worst scenario for my business.
No, it's not. I guess, one thing that occurs to me, and this is something that drove me crazy at my previous job when I was at Morgan Stanley, I was in private wealth management, and no one would look at returns. You'd look at returns after fees in certain cases, and we won't go into it, but in certain cases where fees were kind of hidden, you didn't really need to disclose it. No one really looked at it, but nobody looked after looked at returns after taxes, right? Because in certain cases, like, great, this hedge fund's crushing it. It's getting 10% a year, but our client's a US citizen and he lives in New York City. So he's paying like 50%, so it's like, great, that 10% year over year return is actually really 5%, whereas the S&P, and that's all because it's all short-term cap gains, right? Or in certain hedge funds cases, it's a 80-20 split or whatever it is. But the SPY could just be all long-term cap gains. And, anyway. And so that strikes me as an interesting product. I don't know if that's something you guys have thought about, but that would be something that'd be super cool, because I don't, of course it's all individual based, but, it'd be great for me to go in and be like, right now I'm living in Connecticut. Like, I'm a US citizen in Connecticut. My income's XYZ. I hold XYZ. What would I do if I lent out my, $10 worth of Bitcoin on Gemini? They say it's 3% yield. Would I be getting 3% after net, like under all the assumptions, or like, is it even worth my time? So that type of stuff is interesting. But I would love to see that, because I never saw it in my previous, in the financial world. No one looks at this stuff. And I think it'd be kind of refreshing, honestly. But the last thing I wanted to ask you about is tax loss harvesting. Can you do it in crypto? And two, do you actually think it's a good strategy?
Okay, I'll answer both and dovetail a little bit to your last question as well. And I think that's one thing that we've been building, and we've had support for tax loss harvesting for about 3 years now. And we went through that whole process of like how we can get trust and like get all this access. So the fact that we can aggregate all users' data, their platforms, their protocols, their exchanges, their wallets, we can now start showing them, if you do X, Y, and Z, you will have X, Y, and Z tax liability from that. So like the real-time tax analysis and accounting is going to be like really cool over the next 12 months as we continue to launch some of that out, to be able to see like what impact would I have if I made this trade, if I did that. So I guess that's like the first half. I already forgot the other two questions. So you have to. Well,
the other one was like, really on the question of tax loss harvesting. So I'll tell you, like, so my thoughts is that like tax loss harvesting, when I was learning about it, it's great because it earns fees for the person doing the tax loss harvesting. And you do not pay a lot of taxes in the immediate term. But what it does is that my understanding, and again, I could be wrong, and it's been some time since I looked at it, but is that it lowers your basis. So actually, sure, you don't pay taxes in the short term, but over the long term, it increases your long-term cap gain liability. So it kind of, over the long time horizon, kind of offsets that short-term benefit you get from tax loss harvesting. That makes sense.
Yeah. So I guess it's like,
and I don't know if it's right or not. And but that was just my read on the issue.
Yeah. I mean, there's a few things to tax loss harvesting. One, as far as like a fee perspective, our tax loss harvesting reports come from your free tier all the way up to $250. So there's no like additional charge for using a functionality. We're not like trying to nickel and dime people, you know. So if you could be paying us nothing and still get the same access to tax loss harvesting, granted you've had accounting, all your other reports, all that good stuff. So I guess that's from like a fee perspective. From like a tax loss harvesting perspective, one thing that is interesting and unique in crypto versus like stocks is that there's no wash sale rule.
Oh, that is interesting.
So with stocks, let's say I own Apple and Apple's down 20% and I want to sell my Apple right now. I can't buy that Apple back tomorrow or the next day or the next day. You have to wait a certain amount of time before you can buy that security back, because crypto is not a security but a property. So that's like the one time you get an advantage in crypto.
Oh, interesting.
You can buy that back the same day, the next day, the next day. So let's say I'm holding Uniswap at a 90% loss. I can sell my Uniswap today to lock in that loss, which would offset my capital gains for the year, then buy it back tomorrow at an even lower cost basis, and like keep going. So it's like there's a lot of
that's super interesting.
Really cool stuff that you can do in crypto with tax loss harvesting, and we provide that report to every user. And yeah, so because there's no wash sale rule in crypto, there's actually a lot of advantages that you can do by using that. The one thing that I would say is that like when you're selling that asset, there's a capital gain for selling that asset. So yeah, you're offsetting, you can like lock in that loss. And that's like the good thing is you're locking in that loss, but you're still you're gonna have to report that event on your like 8940 and that I sold Uniswap at X amount and whatever. So yeah, there's mostly advantages from using tax loss harvesting in crypto, and especially because there's no wash sale rule. So because the fluctuations in crypto, you can see something up 10%, down 10%, up 10, like, and you can technically trade in and out of that.
Yeah, if you retain a long-term super bullish view and you think Bitcoin's going to 500K and it falls 30%, you're like, well, fuck, I'll take advantage right now, sell, and then rebuy. That's interesting, because for our listeners, you can't buy, if you hold Apple stock and you want to sell it for a loss to realize that loss, you have to wait 30 days to rebuy Apple, something called a wash sale rule. But in crypto, it doesn't apply. Do you think that loophole is going to get closed?
I don't think so. I mean, as long as it's treated as property, and not, like, so the only way that's enforced with stocks is that it's a security. So until we have securities, and we have like a very few select amount of security tokens in crypto that have gone through Reg A, Reg CF, Reg D. They're actually securities. You're actually subject to like securities laws. Those assets, obviously, you don't have the same flexibility. But as long as crypto is treated as property and not a security, then you're still gonna be able to use that. So that goes back to the other question of do we think we'll see it go from property to currency? I think we're going to stay as a property, and I think you're going to see that that luxury of tax loss harvesting, but you're going to see the flip side of that of every time you go from Bitcoin to ETH to this, ETH to that, you got a taxable event every time. So it's like each industry, I guess, has its advantages and disadvantages, but tax loss harvesting in crypto is definitely a big advantage for crypto investors.
Yeah, no, that's interesting. I didn't know that. Some reading for me to do. So we are out of time, and I wanted, the last question I wanted to end with is how can we be helpful just as a community to you, to Zen Ledger? Yeah,
so I think we set up a coupon code for all your portfolio companies to be able to take advantage of. So maybe we can link that in the show notes. So that's, obviously if you're listening to this and you're in the network or, looking for crypto tax help, we'd love to be able to help you out. Paul can link the discount code in maybe the show notes or something like that, or and make sure we can get you squared away. So, I think, you've helped, anytime that we can talk about crypto tax, provide more knowledge and provide more exposure to the industry, I think it is good. So yeah, man, I think you've helped out a lot. It's obviously a privilege to be able to come on and talk with you for an hour and hopefully give at least some knowledge along the way in between my long rambles of giving some people some advice and some tips and some tricks. And then I'm available on social media. So if you're on Twitter, my handle is just DHannum8, DHANNUM8. So if you have any questions, comments, concerns, feel free to email me. And then my team, our website is ZenLedger.io, and then hello@ZenLedger.io. So we have a full-time customer support team that's available 7 days a week, 12 hours a day by email, chat, phone support. So you have questions, comments, you want to give us a try, you need some help. If you have the situation that Paul mentioned earlier and you need help from 17, 18, 19, 20, we offer multi-year discounts. Like we can get you squared away pretty much in anything that you need. So yeah, I mean, it was an honor to come on the show. And if anyone has any questions, happy to answer them.